Hello, everybody, and welcome to My Print Hash for week 30 of 2026. I'm your host, Cameron Otsuka, alongside Matt Dines. And this week, we're going to take you through kind of the set of turn of events that started with some Houthi threats to block the Red Sea, has led to escalations with Iran, and then the signing of multiple deals with Iraq, and a few other things that we'll touch on. But I wanted to start today's episode, and Matt wanted to start today's episode, going through sovereign debt markets, connecting some dots from there, and then making sure we all understand kind of what is actually underlying some of these things that we're seeing in the sovereign debt market. So let's go ahead and start the episode. Matt's going to be really the one running today's show. He's got all the details for all of us here. I'm really going to be learning alongside the audience today. So let's go ahead and kick it back. I think, Matt, the first slide I'm going to put up here is a flashback to a prior episode that we had talked about. So Matt, go ahead and take it away.
All right, so yeah, we're going to start with if it bleeds, it leads, and sovereign debt markets are on the bleeding edge of the news headline. So figured we start there. That's where people's attention is gonna be, and then we'll build up from that. So the legacy sovereign debt markets, like in our mind print hash framework, they represent the print part of those three tools: mining, printing, and hashing to secure a money, right? And more specifically, this legacy monetary system that we're leaving behind, that just solely utilizes and focuses on the print mechanism to defend its monetary system, while just leaving aside the other two. Mining being kind of the ancient technology. We've known about it for a long time, using coinage or gold as base money, silver as base money, and then Bitcoin with the arrival of hashing. But I want to open with a flashback to a slide we showed on our show on May 28th earlier this year, roughly 2 months ago. And this quote came from the European Central Bank's financial stability review document. Um, Really started here. You look at the highlighted part in the red box. There's this open heart surgery underway in global energy markets, that we're talking about, just feeling the elephant in the dark, if you will, with the Venezuela situation, the Iran situation. We'll talk about those, don't worry. But notice what we saw here, the quotes, the acknowledgement that there was an abrupt repricing in sovereign bond markets ahead, and that this would pose risk to euro area financial stability. So they called their shot, telegraphed it, and what we're seeing right now in debt markets, yield curves, etc. This was all kind of noted. We saw this coming. So as we kind of unpack what's going on, note that this does go in narrative context with everything we're seeing in a very volatile year in, I guess, history underway in 2026. So looking at, this is the world bond markets function in Bloomberg. We see, in the yellow box I highlighted on the range, pretty much all sovereign debt, like every country's sovereign debt, is trading at yields hitting their 52 weeks highs. The U.S. Treasury, Canada, note Mexico's U.S. dollar denominated debt. We'll talk about that in a second. The UK, Eurozone, and then the Southeast Asian economies who are part of this order, like Japan, Australia, New Zealand, and South Korea. That whole group represents what I think of as the entirety of the Western coalition that came out of the post-World War II order.
Sure. Yeah.
Um, Quickly, what I want to talk about is the dog not barking, to lift the term from the Sherlock Holmes novels and kind of detective crime scene analysis. Notice which yields are bucking the trend and are not at all involved in this sell-off. So number one is China, whose 10-year yield sits at about 1.7%. That's still reflecting, so the Chinese economy, this nascent emergent thing, over the last 40, 50 years, as a parallel structure to that post-World War II order that we talked about earlier. Its own economic and monetary situation, think about it as a mirror image of the situation facing the Western allied conditions, right? All right. Number two, to call out the dog not barking, is the US dollar debt from South American countries, including Brazil and Argentina. So these yields are still high. Notice Brazil paying in dollar terms 5.75% type of level. Argentina at 8.5%. Those are like while high in terms of spreads versus the United States 10-year Treasury rate, dollar denominated, obviously, of oh, sorry, I was looking at the low there. Brazil's US dollar rate is 6.3% nominal is where it's trading, 9% for Argentina. That's in comparison to the baseline of the US 10-year at 4.7. Notice, however, that those two, the South American dollar denominated borrowing in terms of spread, is much lower in terms of its overall range than we're seeing from Mexico at 6.5%, roughly. So, what's going on here? There's a key tell. Look at China and then the Latin American U.S. dollar sovereign borrowing costs. This is a key tell as to what I see as like two competing and emergent financial spheres that increasingly look like they're set on a collision course or will be competing with each other over the potentially the course of the 21st century. Noticed within the Latin American U.S. dollar denominated borrowing group, you've got Brazil and Argentina going one direction, Mexico going the other. That reflects a competition, I believe, for the give and take or the pull in terms of the alignment of each individual country within the Western Hemisphere as far as which block they're going to pull towards. Is it the old offshore dollar or the new emerging, call it the stablecoin dollar standard? We're very early in that process, in my opinion. Still first inning. We won't even talk about it today. That transition. A lot of people ask, where are we in that process? It's still in the
Very early.
Yeah. Okay. So you can see that abrupt repricing that the ECB talked about coming into being on the chart of the German Bund. This comes, 2 weeks ago, we had that horrible 10-year Bund auction. We talked about it, won't reference it, but there were just not enough bids for the capacity that the German government wanted to raise, but also roll over their existing debt. So the trend line since we exited the ZERP policy era in 2022 has really been just an unbroken up and to the right on the German Bund yield chart. If you look at the U.S. Treasury 10-year, you can kind of see the respite we've taken in 2024, 2025 after that bond market impulse and the sell-off. One of the top, 2 or 3 worst years for U.S. dollar denominated debt markets in 2022. In the nation's 250-year history, you did see like a pause in 2024 and 2025 going into this abrupt repricing that the ECB's financial stability review hinted at. But for Eurozone yields and their key, call it risk-free asset, the German 10-year Bund, you really don't see that much of a consolidation or respite for borrowing costs there. So just see the vertical, or the up and to the right trend on yields. Then you see the horizontal line on that 3.2% level. We're just bumping right into that. At this point, it seems like there's really nothing to do to stop this. You've got that financial stability assessment from the technocrats and in the European Union, basically acknowledging, this is going to happen. To make an analogy, everybody probably saw or at least caught wind of the World Cup final this Sunday,
Yeah.
and Spain versus Argentina. It's kind of like one of those games where you watch the game go along with Spain's defense and possession control. The outcome was really all but inevitable as the match went on, and it was very clear here which side was ultimately bound to prevail. Pretty much the same dynamic you see here on the chart for debt markets, sticking to this post-war monetary framework here. Yields that the abrupt repricing at this point, there's not much to be done other than sit and bear it, take your beating. All right. So a quick look at sovereign CDS shows that what markets are saying is it's not really a solvency issue or a credit risk issue. Notice the Eurozone sovereign CDS are at the low end of their 52-week range. Um, the U.S. and the Indo-Pacific countries, Japan, Australia, New Zealand, South Korea, I mean, excluding South Korea, like U.S. and Japan, Australia, New Zealand, they're kind of at the high end of their range, but in nominal terms, it's really not that high, right? So you've seen yields go up, CDS go up less, in lockstep. What this is telling me is markets aren't pricing this as a credit risk issue. The rise in yields equates to market saying this block of economies is kind of at the edge of its resource boundary kind of frontier. And what we need is higher real rates to pull in capital, increase savings, and ultimately that savings will be translated into investment to build the physical capital stock that by deploying these savings into fixed capital investment. What does that mean on the ground? All right, I'll give an example here to make this concrete, tie it into the AI build out. We've been talking about DRAM prices. Yeah, Cameron and I can't remember the first month we put this slide in context, but it was, if you go back
Been a
and look at
bit,
our
yeah.
history, it was October. Once this line started to break out, we were on this price trend pretty quickly. Um, in hindsight, this breakout in DRAM's prices started during the key events that developed in that month of October. So remember what happened. We got the escalation in tensions between the US and China as the US Treasury negotiated a deal with Argentina to help it defend its peso from attack in the foreign exchange markets in the weeks leading up to its election, which ultimately Javier Milei and his new La Libertad Avanza party prevailed in forming like consolidating power in their own, I guess, congressional body. But that caused a lot of heat in the U.S. China relationships, right? We talked about Brazil, Argentinian U.S. dollar yields. Notice those are coming down as the Latin American countries, South America, the resources in the Western Hemisphere align together and are forming an economic bloc. Well, China had plans for those resources as well. That caused a lot of friction in the U.S. China relationship. And as you remember, there were talks in Geneva to kind of put that tension back under wraps or lower the simmering in the room. And if you recall what happened, China threatened to withhold access to critical minerals, rare earth supplies. Um, what we got out of the Geneva talks was a 1 year kind of delay in tariffs, all of these economic implementations just around the competition for resources, regional power spheres butting heads up against each other, et cetera. Um, that just to keep a sense on calendars, because we'll get into the timeline. And this is something we'll talk about. We won't get into every detail, but there are a lot of key kind of bottleneck events in the next 6 months
Yeah.
that creating pressure, creating a forcing function that on this entire situation we talk about with money, fixed income, resources, AI, geopolitics, all of the above. It's a loaded calendar. But one of the key ones to keep your eye on is that tariff truce that was agreed to after the October tensions, the Argentina election rolls over, all of that. That agreement lapses on November 10th. So, kind of we're living in a world where it's just one pressing urgent deadline after another. Um, that rare minerals resource constraint is an important like factor among multiple factors driving interest rates higher in the post-war economic bloc. How do you know that? Well, the growth in the U.S. economy is heavily dependent on this AI build out. That AI build out requires metals. Like look at all of the inputs that go into like an AI data center, whether it's GPUs, server racks, concrete, on the ground, etc. It takes a lot of minerals, and it is no coincidence, in my framework, looking back on this, that DRAM pricing, that like we start to show the resource constraint in the Western economic order uh, right in October of 2025.
Yep.
All right, so um, in hindsight, or sorry, not in hindsight, but like in real time here, these last 2 weeks, what we can see, that process, like we're consuming all of those resources, we're running into the boundary constraint. Um, we're seeing it now show up in yields for the companies involved in the AI build out. So notably, Oracle being the textbook case. This company has relied heavily on tapping the U.S. dollar public bond markets, not just in the first half of this year, but like multiple years. This is of the um, AI data center build out, involved companies, the hyperscalers, et cetera. Oracle is the one that represents the most heavy kind of dependence or allocation of of capital coming in from debt and credit markets. So what you can see here in the last 2 weeks, it's, we talked about sovereign yields rising. You gotten hit from a double whammy, and it's showing up in Oracle notably. Top chart is like nominal yields. This is just one bond, an Oracle 2034. Um, I would go back further in the history of the chart. I got back to 2024 pricing here. For some reason in Bloomberg in the last couple of weeks, the prior data on this is cut off. The furthest I can go now is 2023 or 2024 on bonds. I don't know what that issue represents, but that is a new development that bond traders will probably notice if they're trying to find good data. But yeah, general public like this, yeah, you wouldn't see this on Yahoo Finance. Um,
No, I wish.
you see, all right, this is 2034, which is 8 years away maturity. You can see the yield here up, it's 6.69, 6.7%. That's the market yield on the Oracle bond. And then you can see below this the benchmark U.S. Treasury bond. I got the American flag pointing to it. It's trading at a 4.62. See them both rising, but then on the bottom chart, the difference between those two, that's the Oracle credit spread that the market trades the Oracle's debt at, representing the credit risk of the borrower. You can see that number blowing out to over 200 basis
Widening.
points. Yeah, this is something. This represents like a real development to be aware of. So in my framework, this basically reflects a world where we're running at the limits of our existing resources to create further growth in the economy. Now, to go from here will require increased savings to funnel into and continue on that investment process. New growth from here requires building up the savings in the financial channel of the American economy, or America, like more broadly, America's trade partners in this emergent uh, American order, Pax Silica, all of that. We won't talk about that today, which will then get funneled into fixed investment. So you can see examples of that fixed capital investment for yourself if you're like driving through or flying over Boise. So I was recently here. I just wanted to point this example out. So what's going on is the consumption side of the economy, the higher interest rates are placing an incentive on, say, the household side of the economy to belt tighten with our savings as big projects like this massive fab and Boise work towards their completion. Once we finish this massive project, or there's several of them like these throughout the country, that reduces the like kind of the bottleneck as we push up on that resource constraint. You can see it in like that DRAM prices chart we showed above. But that's really what we're dealing with here. So we've entered this new phase. All of the all the hyperscalers, the AI build out firms, et cetera, they went through that process of sucking capital out of credit markets, or even say SpaceX with the that
Oh yeah.
massive IPO, which I don't have the chart here. It's down 50% since its IPO. So you've
Yeah.
already got 50% retracement in 1 month. They pulled all the dollar capital out of the table, off the table, like literally preparing for this next phase where dollars become
Right.
tight, resources become tight, and the only way out is to invest. When I say invest here, I don't mean invest like buy stocks on your Robinhood app or trade, day trade cryptos or altcoins, whatever. I mean, like investment is like that.
Physically building things.
Build long-term
Yeah.
durable goods, all of that, real stuff. All right. So just one example here too, just to close this one out. In a pre-recorded interview, Jamie Dimon gave the public his guidance on everything going on and what this means for the short term for the American public. Um, you know, he's just a guy, right? But he sits in a very high up seat. He can see the system, everything going on with much more clarity and deeper horizon than uh, most everybody else. But he said specifically he would not buy long term bonds or the S&P 500 at current prices. So this is how kind of he's advising or steering the general public in an interview to be aired. I think it was on 60 Minutes. Maybe it'll be on the air this Sunday, but the specs are already or the general talking points are already floating around on central media. So that's what we see here in sovereign debt markets. We've entered a new era. The punch was telegraphed, and it showed up, within a couple of months. Rather quickly, but this was predicted, if you will. All right, so that takes us to Iran, on a new topic, but definitely interconnected, interrelated, um, where we've entered the next phase of escalation, and that's become pretty clear after a 3-month lull between the ceasefire on April 7th, and then this new ramp up of targeted kinetic strikes that really began in the last week or so. It started with, hey, um, a couple of maybe tankers traversing the Strait of Hormuz were attacked. U.S. does a retaliatory strike. We've seen now, soldiers attacked, killed, etc.
Yep.
U.S. escalates strike further. It's built up to the escalation point again, and it's broken out. So for anybody who was betting that light memorandum of understanding would hold and would progress to a new deal, well, it looks like you've lost
You
that bet.
lost that bet.
We're ramping back up, and this conflict has taken on I'd call it the third phase. So first phase, Epic Fury, was a target of IRGC, military, equipment, radar, um, you know, attack facilities for
Yeah.
military purposes, all of that. All right, once that worked itself out in the first, it was really 10 days or so. It was rather quick. Then it moved into economic fury, which was basically knocking out Iran's financial architecture, um, banking infrastructure, all of that. OFAC sanctions would have been part of that, or you could say also trading counterparties for Iranian oil exports. So you saw Treasury target, say, a lot of Iraqi oil traders as targets of its sanctions, all of that.
Right.
This is a new front in my read. And you can see it on social media, but it's really targeting the real infrastructure of the economy. So roads, bridges, power plants, etc. We'll get to that, but it's the new phase of this conflict. Um, it's sad to say that this is where it is, but this is a process, like 50, 100 years in the making. All the other paths out of this that they've kind of consolidated on this one route. The only way out is through. Is the sad truth of it. So where we are now, the Houthis have now cut off access to the Red Sea for Saudi oil exports, which has created a second wave in oil markets with both of those sea routes now closed. So the Bab al Mandab, is the gateway into the Red Sea, Strait of Hormuz, the gateway into the Persian Gulf. Both those are blocked. In practical terms, what this means is a drop in access to energy economies or exports from the Middle East for the Southeast Asian economies, in particular China. So, note in this article text, the processing rate for Chinese refiners have fallen 18% year on year. We're really seeing that same effect across the globe. And kind of judging by what we're seeing on other fronts, so including Ukraine's drone attacks on Russia's refinery infrastructure, you could also look at the story in California of the um, I don't know how to phrase this correctly here. The regulatory uh, destruction. I don't know what you will. The slow moving regulatory attack on California's refining capacity. I think that's a safe and correct way to say it. Um, it doesn't take Captain Obvious to blurt out or tell us that this is like you can see what looks like a coordinated strategy here. The result is of that strategy, the tightening of global refinement capacities, is we're seeing diesel consumption fall an estimated 10% year on year in China and Europe by 5.7%. So think about diesel as a key input to that investment cycle we talked about earlier. Look at all the heavy, go back and look at that photo if you will, if you wanted to roll back the tape, but look at all the heavy equipment involved, the big yellow trucks, the trains moving, or sorry, the cranes moving around the site. That all runs on diesel. You pull the diesel out, you don't get that growth. So you can see kind of, if you think about this as a global war, definitely a capital war, definitely a kinetic war, definitely a cyber war. You can see the energy markets and what's going on as kind of a key cog in that kind of battle plan. All right, so just this is a graph here from a Reuters article with that Red Sea route blocked. Those energy commodities, you can see the traffic pickup here starting with March when Epic Fury began. You see the escalation of export traffic or export transport through the Red Sea, going through the port of Yanbu during the call it the Iran War. Um, those picked up. Now those are closed off. So the closure of the Red Sea, if you really think about it, look to where those oil cargoes were going. They were headed to Asia, like the dark blue in those lines. I know it might not be clear because all the shades of blue are so close. Tiny sliver going to Africa, basically going like the rest of them nowhere else. So closure of the Red Sea, what's blocked here? It's energy commodity access for Asia. The bulk of those would be hitting the Chinese market. Um, so yeah, everybody in Asia is going to feel the brunt of what the Houthis are doing, but China is going to take the bulk of the hit.
Right.
All right. So the military policy from the U.S. is now a head for an eye strategy, as Marco Rubio called it today in a press conference. Donald Trump indicated in a Truth Social post, um, uh, like kind of a promise to bomb Iranian infrastructure for any ships that are now hit in the Hormuz. Um, Another post shows the Houthis are included in that ultimatum. So this is a sad fact of life, but this is where we are. Um, we're kind of pot committed here. We've already unleashed Pandora's box. There really is no way out of this now but through. Um, so now you get into the U.S. Deals with other countries. If you squint here, this is where you can see some hope for how this whole thing works itself out down the road. The bombings and the social media threats are not the actual path out of this. Um, that can't bring a new stable framework, right? It just more war is not going to be good for markets. I didn't pull a quote here, but that book I keep referencing, I read it earlier this year, Gold and Iron by Fritz Stern, about the buildup of the Prussian Empire. One of the things you notice, the book, as I've highlighted, focuses on two characters, Otto von Bismarck and his private banker, Gerson von Bleichroder. Um, Bleichroder was involved in mainly sovereign debt capital markets. And one of the things that comes across there is war is bad for yields. When you when you see war break out or tension simmer between any two bilateral parties or groups of parties, yields sell off. Um,
Yeah.
IOUs do not like conflict. Um, so that's that to bring that into the fold where we started from, the sovereign debt sell off. The debt is selling off because it doesn't like the developments it's seeing on the war front, if you will, or the collision that's underway.
Right.
The way out of this is actually economic cooperation. So you need to look at the business development front in global energy markets, themselves for that. It's insanely complex. Um, and all of these bespoke relationships between the producer regions and the consumption regions, like I compare it, like I call it an open heart surgery, as we're rewiring literally all of those relationships um, to connect supply and demand together. It's a complicated process, like it truly is rocket surgery. We'll see how it all works out, but if you squint you can see some early shoots of what that new world might look like. One example is the headlines that came out of Iraq this week, signing 48 deals with U.S. companies worth $60 billion for energy infrastructure, pipelines, et cetera, that would provide the backbone for how future trade and energy flows will connect the consumption markets with the production from the Middle East. Um, think about this in Iraq, and then all of these pipelines, and then where they ultimately connect. That's just one interconnected node in a much broader global energy market patchwork. Like think about Venezuela as a production source. We won't talk about it
Yeah.
anymore today, but a lot going on in Venezuela, both with its energy production and getting a hold of investment it needs, the debt workout situation. That's probably a 2027 story, not something to be resolved in the second half of 2026. But with these pipelines that were just signed, these are MOUs. Uh, you can see the gravity, pulling in a certain direction with an intent to set up the energy flows north to go north and westward over land and water, as opposed to going south and east by way of the Red Sea or Strait of Hormuz. Right. So
Right around those bottlenecks.
yeah, exactly. So you can see this this direction taking shape. Notice here the companies called out: ExxonMobil, KBR, GE Vernova, Shell, Halliburton, um, large Western energy majors, industrials, etc. And then also Syria involved with cooperation to reconstruct the long defunct Iraq Syria pipeline, which after 20 years, 30 years of war in the region, the rebuild is underway. You tear it down so you can build it back up, essentially. All right, and then finally, like to shift our focus, like another area of the globe, spin the globe. If you don't have one, go buy one. On the sides of the ASEAN summit this past week, we saw an announcement from the Quad, which is U.S. and then Australia, Japan, and India, as kind of the regional, um, I guess, powers, who were kind of forming an antipode to mainland China in its desire to expand its economic sphere, both eastward, which is blocked off by the sea and the island chains, and then westward by the land, which is hard to conquer and maintain economic sovereignty over. The further you expand your supply chains, etc. But you saw this statement, which was kind of milk toast, but was quietly saying, um, saying the quiet part out loud, right? So you see the call here. If you read it on the right, the takeaway here, it's not saying much, but it's also saying everything if you read between the lines, equating peace and stability in the Indo-Pacific region through security and prosperity. So security implies defense, prosperity implies economic growth. You see the underpinning of everything we've talked about earlier in the show, kind of lying there latently below the waterline, to like the deeper part of the mass of the iceberg. On top of that, you saw Marco Rubio meet with Chinese officials on the outskirts of the ASEAN summit, which is a lead up to the scheduled visit for Xi Jinping and his contingency to arrive in Washington, which is tentatively scheduled on the calendar for September. I believe that date is still penciled in. Could get delayed. Any little skirmish could kick the can down the road. But that's what we talked about. The second half is absolutely loaded with deadlines, forcing functions. It is truly packed. But for now, the thing right in front of us is it looks like we're just going to have to brace for and weather that punch in the face that we know is incoming for long-term sovereign debt markets. And then we just take it one step at a time from there.
Yeah, I mean, just like seeing all of these things kind of laid out, kind of back to back, and I really like how you connected it back to the sovereign debt markets too, because that made me understand. Okay, we're seeing those spikes. There's more to it than just more printing, right? Which we already expect, but to your point, it is also interconnected with this geopolitical piece. So,
And then I think the silver lining, we're not going to go back and show that table of the world bond markets, but what we're seeing in U.S. dollar debt or U.S. dollar denominated debt from the South American countries, so Argentina, Brazil, etc., that's an early indicator that the growth in the Western Hemisphere and this new U.S. Kind of framework and coalition it's building for the 21st century, there's a real path there. So I know it looks dark from the developments coming out of the Middle East, but there definitely is a positive underpinning to it potentially. We'll have to watch, see how this develops, but that's your silver lining. Stay positive when the going gets tough.
yep. Well, with that, that's our episode for this week. Thank you as always for watching. If you like this, if you want to share with your friends, all of that, please do so. That really helps us out. You can follow us on YouTube, Substack, as well as on X at FinePrintHash. Follow Matt at LeveredUSTs. Follow me at Cameron Otsuka. Thank you all, and see you next week.